For a long time, modern finance was chasing this one really bold idea. Could we define risk with mathematical precision? The dream was, if you can actually price risk, you could build a financial system that's truly rational. So, how did this whole powerful idea even get started?
This was the fundamental question, right? Before the middle of the 20th century, risk was just a story, a gut feeling. But if you wanted to build a real science of finance, you needed a number. You needed a framework that could take you from just intuition to a theory of prices that you could actually test.
So, the very first step was this radical rethinking of what risk even is. It turns out it's not just about how bumpy the ride is for one particular stock. The real breakthrough was realizing the only risk that truly matters is how that stock moves in relation to the entire market. Okay, here's the key insight. Some risks you can get rid of pretty easily. Like, say, the risk that one specific coffee company has a terrible quarter. If you own 100 different stocks, that one company's problem is just a tiny blip. The market doesn't reward you for taking that kind of risk because you could have just diversified it away. But what about the risk of a global recession that hits all companies? You can't diversify that away. That is systematic risk, and that is the only kind of risk you get paid to take on. Now, to turn this into a model, economists ran a thought experiment. Imagine a perfect world, right? Every investor is perfectly rational, everyone has the exact same information, and trading is totally free. In this world, everyone's got the same goal. Squeeze out the most return for the least amount of volatility, the least amount of bumpiness in their portfolio. And here's where it gets kind of wild. If everyone is rational and looking at the same information, they will all, completely on their own, come to the exact same conclusion about what the best possible portfolio is. They'll all want to own a little piece of everything. And this single perfect portfolio, that's the market portfolio. It's a slice of every single risky asset in the world. So this leads to a huge conclusion. If everyone's holding the same big portfolio, the only thing that matters about any one stock is how it acts inside that collective. Does it zig when the market zags, lowering the overall risk? Or does it amplify the market swings, making the whole thing riskier? Suddenly, how choppy that one stock is on its own just becomes irrelevant. And that's the final leap. Risk stops being this vague concept and becomes a precise statistical term, covariance. You can just think of it as a measure of how much a stock tends to move with the market. And this shift was absolutely revolutionary. The question wasn't, how volatile is this stock anymore? It was, how sensitive is this stock to the health of the entire economy? Now, this powerful logic didn't just stay a concept. It was formalized into one of the most famous models in all of finance, giving us a simple, testable theory. Right, so the capital asset pricing model, which everyone just calls CAPM, took all that equilibrium logic and boiled it down into this beautifully simple equation. It proposed a really clear, direct link between an asset's risk and what you should expect to earn from it. The model's core prediction really comes down to one number, beta. Beta is just a measure of how sensitive an asset is to the market's swings. So a beta of 1 means it's on the same roller coaster as the market. A beta of 2 means it's in the very front car, getting double the highs and lows. The theory says the higher the beta, the higher the return you should demand for taking on that extra systematic risk. And the elegance of this was just striking. All of a sudden, you had this unified theory. Just one factor, the market, explained pretty much everything through one simple linear relationship. For the very first time, finance had a universal benchmark for risk that you could actually go out and test with real-world data. But of course, that kind of elegance comes at a cost. A model that simple and that powerful has to be built on some pretty demanding assumptions. And when this beautiful theory met the messy reality of the markets, well, tensions started to show up pretty fast. Just think about the world this model lives in. There are no trading costs, no taxes. It's a world where every single investor agrees on what the future holds. And this is a big one, it's a world where we can somehow see and measure a portfolio of every single asset in existence. We're talking stocks, real estate, fine art, everything. In reality, that's not just a big ask, it's completely impossible. So when researchers started testing the model, the data just didn't quite line up. The theory predicted this clean, straight line between beta and returns. But in the real world, some low beta assets were delivering surprisingly high returns. And on top of that,
Other things, like how big a company was or whether it was a value stock, seemed to explain returns in ways this one-factor model just couldn't handle. But then came an even deeper problem, the equity premium puzzle. See, historically, stocks have paid this huge premium over safer things like bonds. But when you used beta to measure the actual risk of those stocks, that premium seemed way, way too high. The model just couldn't explain it. To make the math work out, you'd have to assume that investors were just pathologically terrified of risk. The numbers just didn't add up. This left the whole field with this massive intellectual dilemma. Did all this data prove that this elegant model was just flat out wrong? Or was the problem that our definition of systematic risk, all boiled down to a single beta, was just too narrow, too incomplete? These challenges didn't end up destroying the equilibrium framework. Instead, they forced it to evolve, and they pushed finance toward a really critical fork in the road, toward much deeper and more interesting questions. So this created two paths forward. Path one was basically to try and save the model. You keep the core idea, but you add more risk factors. Maybe company size is its own kind of risk. Maybe being a value stock is a risk. Path two was way more radical. Just throw out the assumptions. What if markets don't work based on some single rational consensus? What if some other force is what keeps prices in line? Ultimately, what's really important here is that finding these problems wasn't a failure. It was actually a sign of huge intellectual progress. The simple, clean model started to stretch, and as it did, it revealed its own limits and forced the entire field to confront a much more complex and realistic picture of how markets actually work. And that brings us to the question that would really define the next chapter of finance. If this idea of a perfect, rational market equilibrium is just too flawed, is there another force that can keep prices in check? A force that isn't based on everyone agreeing, but on the relentless hunt for risk-free profit? Is arbitrage enough? We'll get into that in our next explainer.